Hey, good morning, options traders. And I wanted to answer a really important question for our traders in the group. And that is, do debit spreads need the stock price to move in order to be profitable? And this is a really good question because you hear this stuff so much, especially from new traders. And in fact, my motivation for doing this video is that I was on a website just the other day, and there was a little snippet video talking about these strategies that they were touting, and they said, well, the big benefit of the credit spread is that you don't need the stock price to move. And the downside to the debit spread is that you do need the stock price to move. Well, is that really true, or is it simply a gross misperception? Well, quick review. Remember what a debit spread is. It means we're going to be spending money for it. So for this video, let's just talk about the bull spread. Let's say the stock is trading for 100 and the 100 call is priced at $3.50. The 105 call is at $1.50. So if we buy the 100 call for $3.50, we sell the 105 and collect $1.50 back. That is a net debit of 2. That would also be our max loss. So this is why it's called a debit spread. We have to spend money for the spread. Now, because the spread could be worth 5 points, we have the right to buy stock at 100, the obligation to sell at 105. That's a potential $5 payoff. And as I've talked about in other videos, sometimes I'll call this an asset spread. It can actually grow in value from its current price of 2, maybe to a maximum of 5, in which case your maximum gain would be 3. You spent 2, you sell it for 5. That's the very best that could happen. Well, what if we do a credit spread? What's a credit spread? Well, if we stick with the bull spread, maybe we sell the $100 put. Pricing model would say it's also trading for about $3.50. And if we buy the 95 put, that would be trading for about $1.50. Notice that we end up with a credit. We are selling the higher strike put, which has more value. So we're receiving $3.50 and we're spending $1.50. So on a net basis, we're collecting cash. So that's why it's called a credit spread. It's a net credit of 2, which would be our max gain. But also notice that this is no longer an asset spread. It's a liability. It can only hurt you. It can only be worth either 0 or -5. But it cannot help you in terms of growing in value. So the reason is we have sold the 100 put. We have the obligation to buy for 100, and we have the right to sell for 95. So if you buy for 100 and sell for 95, that's a $5 loss. See, nowhere in this equation does it come up to be plus 5. And that's one of the things that people overlook about credit spreads. They are also liabilities. That doesn't make them bad. It's just that they're not assets. There is a difference. So in this case, if we got paid $2 for this spread, but we have a potential $5 liability, then the maximum loss is 3. It's exactly what we just saw for the debit spread. So in this example, whether we did the debit spread or the credit spread, this would be the resulting risk graph. Both are bullish. We would have a maximum gain above 105, in this case, maximum gain of 3. And if the stock falls below 100, whether we have the debit or the credit spread, we have a max loss of 2. They are exactly the same thing. So why do so many people get tripped up? Why do they think that the debit spread has to move, whereas the credit spread doesn't? Well, here's what they do. They say if the stock is currently at 100 down here, I need the stock price to move all the way up to 105 to get me to maximum gain. And then they say, what if instead I did the credit spread? I could sell the 100 put and I could buy the 95. And so now my profit and loss diagram would shift from the blue to the green. So again, remember that the stock is currently right here at 100, and here would be our maximum gain. See, we're already at maximum gain. And this is what leads them to believe I don't need the stock price to move because I've positioned my risk graph here in green so that the maximum gain lines up with the current stock price. How wonderful is that? How great is the credit spread? And this is what leads them to believe that the credit spread doesn't need the stock price to move. So where is the fallacy in this argument here? Well, take a look at your graphs. You're talking about 2 different vertical spreads. The blue one is the 100-105 vertical, and in green, the credit spread is the 95-100. So yes, you have two different vertical spreads. They have two different characteristics. The thing is that they have positioned intentionally this credit spread to be lined up with the maximum gain again at the current stock price. So yes, it has negative gamma and positive theta. You do not need the stock price to move. And yes, for the spread in blue, they have lined it up to be at the positive gamma and negative theta portion. And yes, in that case, you would need the stock price to move. But we're talking about two different spreads. See, the whole fallacy starts with them saying the stock price is 100, and I can either buy the 100 call and sell the 105, or I could sell the at-the-money $100 put and buy the 95. Well, who says that you have to do that? As I've talked about in previous videos, calls or puts or calls, anything that you can do with a call, you can do with a put, and vice versa. So if we can create this supposedly wonderful positive theta graph where we don't need the stock price to move, and we're doing that with puts, I should be able to do it with calls. How do we do it? Exactly the same way. Buy the 95-100 call spread. See, right now we're looking at the 100-105. So if we instead bought the 95-100 call spread, what's it going to do? Well, watch what happens. This blue curve is going to shift right there. It's going to line up exactly where the credit spread does. Notice we have a maximum gain of 2 and a max loss of 3, and yet it's a debit spread. And the reason for this is that if we spend 3, but we have an asset that could grow to 5, we now have a maximum gain of 2. And so again, this is why it's so easy to get wrapped up into these fallacies and make bad decisions, because they're just not seeing that calls or puts or calls, we can do all strategies exactly the same by using either one. Now, as a side note, could there be a difference? And I've talked about this before. Yes. If this is our debit spread for 3 with a max gain of 2, what if in the real world this is priced at $3.10 and therefore has a max gain of only $1.90? Well, in that instance, yes, the credit spread would be better. But what if, instead of being priced at 3, the debit spread was priced at $2.90 and now had a maximum gain of $2.10? Now your debit spread is better than the credit spread. That's the reason for choosing one over the other, or at least one reason. Morphing is another. But you don't choose a credit spread just because you think that the stock doesn't need to move. If you've positioned your graph to do that with a credit spread, you can do the same thing with the debit spread. So if you keep these points in mind, it will definitely help you to make better decisions. And that can only lead to better results. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.